Good morning, everyone. Welcome to the joint webinar between Pett Franklin and RM2. I'm William Franklin. I'm a partner in Pett Franklin. And as many of you will know, we are a specialist practice in employee share schemes, all aspects relating to employee share schemes. We are a law firm, but I'm a chartered accountant, and that's why we're talking about today's subject, which is related to valuation. My co-presenter is Garry Karch. He's the Managing Director of RM2 Corporate Finance, and like me, he is also not a lawyer. In fact, his background is in commercial and investment banking, where for many years he specialised in the strategy and funding of US ESOP arrangements. There are parallels with the US concept of an ESOP and the British concept of an EOT. So Garry actually brings a unique perspective to the issues of EOT funding and valuation. The subject of today's webinar is, as in the title, valuation. But it's very much in the context of EOT-owned companies. We'll look at the basics of business valuation and tax valuation generally, but we'll then apply those to specific EOT applications. During the webinar, if you wish to ask questions, please do. We'll try and deal with them at the end if we have the opportunity, but if not, we will get back to you. Furthermore, I just want to mention that this webinar will be available in due course to download on both the Pett Franklin and RM2 webinar. So, without further ado, let's move on to the content of the content of today, which begins, I think, by having a look at the basics of share valuation from a commercial point of view. Garry, would you just be able to sort of run through some of the basic ideas?
Sure, I'd be happy to, William. And again, welcome and thank you for joining us this morning. We appreciate it. You know, if you look at valuation in general, you know, there are three approaches that are going to be used in one way, shape, or form in valuing a business, whether it's for commercial purposes in the case of a transaction, whether it's an EOT or a company sale, or whether it's for share scheme valuation purposes. They'll all derive in some way from these three basic approaches. And with the exception of the asset-based valuation, when you look at the cash flow basis and the capitalized earnings, they're definitely related, but they take different approaches in getting you to the same point. So let's start with a little bit on the asset-based valuation side. You know, with an asset-based valuation, you know, this is going to be more commonly used, you know, for the most common situations, probably, to be honest with you, in the event of a liquidation. You know, very rarely will you see an ongoing business or a going concern valued solely on the basis of what its assets could be sold for. So it's a very unique, very specialized area of valuation for a going concern, you know, an ongoing business, but it is applicable. You know, as an example, a year or two ago, I actually worked on a transaction for a company that operated a fleet of helicopters that it leased to news agencies. So instead of, you know, television stations, networks buying their own equipment and their own fleet, they actually leased the equipment, you know, fully equipped with pilots, with cameras, etc., from this business. And during the process, what we found out is that the value of used helicopters is almost as high as the value of new helicopters. So when you looked at the investment the company made in its fleet, and then you compared that to the value of the cash flow that the company generated, it was one of those interesting situations where the value of the assets for this going concern was actually significantly higher than the value based upon the other methods we'll talk about here. So, it's not a hard and fast rule that it's not applicable to an ongoing business, but it's going to be a rare situation where you actually see that as the case. And William, I think you probably agree with me on that.
I think that's right, yes.
Yeah. So as you then start talking about cash flow and capitalized earnings-based valuations, what you're really trying to get to is what the value to a buyer is of the cash flow that business can deliver to that buyer or to that owner. So start by talking about more of the pure cash flow based. That's when you hear about the term discounted cash flow valuation, and we'll get into this in more detail. But it basically looks at the future earnings or the future cash flow of the business and asks the question as to what those earnings and what that cash flow would be worth today, assuming you need to earn a certain return on your investment. So it discounts future cash flows back to the present and says, here's what you should be willing to pay for this business if you want to earn this kind of a return based upon these cash flow assumptions. Capitalized earnings is very similar to that approach. You can take a few different perspectives on that. Commonly, you'll see multiples used. So if you look at most common would be with listed companies. You look at a price-earnings ratio or a PE ratio. In effect, you're saying the equity of this business is worth a multiple. Let's just take with a PE of 12 times net income or net earnings per share. You're in effect capitalizing those earnings and saying, here's what the business equity should be worth in that case. You can use a number of different measures. That's the most commonly, I think, understood by the public as a whole, because everybody's familiar, at least has heard the conversation in financial news about PE ratios. But you can use that based upon EBITDA, which is earnings before interest, taxes, depreciation, and amortization. You can use operating cash flow. You can use a number of different measures in capitalizing earnings. So it really tries to get you to the same point as the discounted cash flow model. And as we talk a little bit further in the presentation, they can complement each other as you're trying to really determine what the value of a business would be. So while all of these approaches are used and can be used, the cash flow based methods definitely are at least the foundation for most valuations, usually more applicable as the foundation, but need to be complemented, need to be verified, and a reality check performed using some other methods as well.
I mean, as Garry said, business valuations are generally driven by expectations of future cash flow. Whether you use directly a cash flow calculation or whether you use one of the other methodologies. Because at its base, what one is assuming when one values a business for a business valuation is that one's valuing the entirety of the business and that all of the cash available from the business is available to the controlling shareholders. Now, when we move into the world of share scheme valuations, things start to shift. To begin with, as a general rule, share scheme valuations are concerned with non-controlling shareholdings, minority interests. And that changes the fundamental assumptions. The shareholders in that situation don't have control over the entity's cash flow. And you then need to start thinking about what that impact has on the valuation. Typically, the result is that one very often discounts the value based on a sort of controlling holding to allow for the fact that these shares don't really control the cash flow in the same way. With share valuations, we're often concerned with making awards under the various tax advantage share scheme arrangements. So we then actually have another angle which is different from general commercial valuations. We have the approach of HMRC as regards the taxable market value. Now that's governed not just by commercial principles, but also by tax law, case law, and not least HMRC practice and the practice of share valuation practitioners in the UK as those have evolved. That leads to differences in the way one might value for tax purposes. One thing particularly that can cause different numbers to arrive is the concept which you have in tax valuations of the information standard. That's the idea that for valuing for tax purposes, you make assumptions about the level of information that will be available for the purposes of that valuation. And that can mean, for example, that detailed cash flow-based valuations are inconsistent, possibly, with the information standard. And that can mean that when you look at valuations for tax purposes, the centre of gravity of the valuation can shift away from cash flow to some extent.
And William, would you say it's probably, virtually impossible to truly do a discounted cash flow analysis for a lot of the share scheme tax advantage plans, just given that information standard makes it difficult?
I think it's quite unusual, actually, for share valuations that are agreed with HMRC to use detailed cash flows. It's not unknown, and HMRC will not refuse to look at valuations. In fact, in many ways, they would prefer valuations on that basis. But because it means conceding a degree of information to HMRC for the purpose of the valuation that might not be consistent with the information standard, there's often a sort of hesitation about doing that. Plus the fact that many smaller companies that grant employee share schemes often don't have comprehensive cash flow information on which to build in the first place. So one has to use proxies for it in the form of earnings multiples and the like. So that's about the sort of generalities. As I said, today we're really trying to relate these to the context of employee-owned companies. So we thought one way of doing that would be to look at a case study. Now in this particular example, I want you to imagine a company which has revenue turnover of about 5 million, and an EBITDA profit, that's earnings before interest, tax, depreciation and amortization, of £1 million. The situation is that the shareholder who owns this company is seeking to retire and is attracted or wishes to sell the company to the employees through the mechanism of selling his shares to an employee ownership trust. What's he trying to achieve? Well, he's trying, yes, to incentivize the next generation of management to continue the business after he has gone. And he is also looking for some return on his years of working in the business. He would like some cash out of it, ideally at completion, with the remaining amount of the purchase price payable over a longer time period. That's the general setting, but Garry is going to address a number of the key questions that arise from that situation.
So for most of the remaining part of the presentation this morning, we're going to walk through and try to address the questions you can see on the screen, starting with the value of the business, and then going beyond that and looking at the implications of valuation if you sell 100% of the business to the EOT versus selling a portion now and a portion later. The incentivizing of key management to a vendor in this particular kind of situation is very important, because if you look at the objective of some cash at completion and the remaining purchase price paid out over time, getting paid out over time is going to be completely dependent upon that succession management team being able to continue to manage the business effectively, ideally grow the business over the period of time over which the vendor would be paid out, So that's a key factor that we'll talk more about as we get through this. And then you come to the question of, how do you value management incentive shares? How do you provide the greatest incentive to the successor management? And as we say management, it could be key employees who aren't executive management, but the people who are important to the continued success of the business. And then we're going to bring in what we think is a very important, but probably relatively new concept, to most of you who are on the webinar this morning, is how a lender, and lender we can define as either a third-party lender like a bank, like a credit fund, or it can be you or your client, if you're an advisor, as a lender in the transaction. How would they view the transaction, and how would they look at company value? Because there's a point at which a lender is going to look at a transaction and say, I'm not comfortable with the overall leverage that's being put on this company to fund this, what it amounts to a buyout. And they will take that perspective, as a bank. And our view is that a vendor should also look at this, and this should be part of the thought process of how much value they think the company should be able to provide them, given the reasonableness of the debt level and the capital structure and how you can repay the debt incurred to complete the transaction. And then finally, we're going to close with how do you reconcile the differences in valuation? It would be the rare vendor who doesn't think their company is worth more than the buyer thinks. I think in the course of my career, I have rarely, if ever, run across that where a vendor said, no, I think my business is worth a little bit less than you're talking about paying me for it. So, there's definitely a need in many cases to reconcile these differences, and we'll talk about a couple of techniques that can get you there. So let's go ahead now and address our first question. What is the business worth? So we're going to start and talk about valuation from a discounted cash flow perspective. Keeping in mind the general concept is that the value of any asset to a buyer, as we mentioned earlier, is determined by the future cash flow it can generate, and then how you look at those cash flows and express those in current pounds. So you're going to get proceeds, you're going to receive cash flow over time, but what would I be willing to pay today to receive those future cash flows? So what we've done here is put together a very simple analysis that walks through the basic framework of a discounted cash flow valuation. So let's start on the left-hand side where you see the DCF analysis text. And WACC, which is the foundation of the discounting method, that stands for weighted average cost of capital. And the way that's determined is based upon an assumed capital structure for the buyout. So in effect, how much debt in a commercial transaction would be used to purchase the company versus how much equity would go into the capital structure from the buyer's perspective. And you in effect then average the cost of the finance with the cost of the equity that would be required to get the finance from a commercial perspective, taking into account the tax implications. And in this case, our core discount rate, or weighted average cost of capital, was calculated to be slightly over 14%. So that's going to be the discount rate as we look at the actual valuation numbers to the lower right that was used to bring the future cash flow, which is what FCF stands for, back to the PV, or the present value. We assumed, as William said at the intro to the case study, that the EBITDA, or in effect operating cash flow, for the last 12-month period, so TTM is trailing 12 months, is £1 million. We're projecting very modest growth going forward for the business. So you can see the growth in EBITDA, or operating cash flow, over the 5-year valuation period. And then what we'll talk about a little bit more is the sensitivity analysis. So what we've also done, and these numbers aren't on the screen, but I'll walk you through them a little bit. We've said, what happens if the actual discount rate is higher or lower than we've assumed? What happens to valuation? And William's going to talk a little bit about the implications for the changes in the weighted average cost of capital in this context in a minute. So then what we do is we take year by year, generally for a 5-year period, and we go from EBITDA down to what we call a free cash flow calculation. So free cash flow gets to that point of, if I buy this business, how much of the cash flow is going to be available to me after I may pay my corporation tax, after I invest in working capital, because you're going to probably, as you grow the business, see a need for greater levels of stocks and debtors that has to be financed somehow. So that's going to take cash flow. And then we've assumed that the company is going to purchase new capital assets, machinery, equipment, what have you, each year equal to 40,000 pounds. So in 2017, if you take this first example, we start with our EBITDA of slightly over 1 million pounds. We take off the cash taxes of 185,000 pounds. We take off another 90,000 pounds for the investment in working capital and the capital spending, and that leaves cash flow available to the owner of the business, the free cash flow, of 755,000 pounds in year one. Now, if you say that 755,000 pounds basically would be received, and the reality is over the course of the year, the valuation assumption that we're using is that it occurs at the end of the year. So you need to bring that number back 1 year to see what it's worth. Another way of looking at that, where you can see then that 755 is worth 662,000, is if I had 662,000 pounds today and I earned 14% on it, I would have 755,000 pounds at the end of the year. So it's basically discounting is the opposite of compounding, and in this particular case. So just to try to explain that concept a little bit more. So you go through the 5 years. You have those discrete numbers each year of what the present value of the future cash flows are, but there's this big number out to the right. So when you see that term terminal value, most of the value of an ongoing business, and this assumption you have to make in a discounted cash flow analysis, is that it will remain an ongoing business basically forever, unless there's a set term at which the company is going away. So you have to assume that the company then will continue to generate those cash flows in those proportions basically into perpetuity. And we've assumed, if you look at the top, that the cash flows will continue to increase by 3% a year every year from year 6 on. So you take those cash flows, which are discounted as a perpetuity, and we won't go into what that actually means, but you discount those back to the present. You add those to the present value of the first 5 years, and that's going to give you a DCF value, which is basically, in effect, the enterprise value of the business versus the equity, because enterprise is the company ignoring any kind of debt, ignoring any kind of excess cash. That's your initial step in getting to the enterprise value. We have no debt in our assumption for the case study, and we have no excess cash flow beyond that what's necessary to operate the company. So we're saying the company has been operated efficiently. They've taken cash out over time when they felt it was appropriate. So what's in there now is what you need to run the company. So this gives us an enterprise value of 6.5 million pounds, which equates to an EBITDA multiple of 6.5 times. And before I turn it over to William for a couple of comments, the one thing that's really important to understand is when you look at the sensitivity analysis over at the top right, under the top level where we use a discount rate of 15.4%, under that scenario, the enterprise value of the business drops to 5.8 million pounds. And if you use the 12.6% discount rate, it increases to about 6.8 million pounds. So you can see there can be a pretty significant swing in value using a discounted cash flow analysis based upon the assumptions that you use for the discount rate. So there's definitely a little bit of art rather than science that goes into this. And William, I know you've got a few comments.
Well, that's right, Gary. I mean, I think sometimes when one looks at DCF calculations like this, there is with all these numbers, there is a sort of danger of being sort of lulled into a false sense of accuracy from DCF. As Gary's pointed out, the actual final value of the enterprise is highly dependent on, and this is generally true, not just in this example, of this number right at the far end called the terminal value, which is basically based on extrapolating existing trends or assumptions over the next 5 years way into the future. So there's obvious problems with that and risks with that, but that's the way the methodology works. And as you can see in this example, the majority of the total value derives from the terminal value. So that's always one reason one is a bit cautious with this methodology. Another factor that just needs to be borne in mind these days is this weighted average cost of capital. Now, there are various ingredients that go into that figure and assumptions, but this has actually become quite a difficult area in the last few years or so. If you cast your mind back to the late period of 2007-2008, when the banking system, in some respects, failed globally, the result of that since then has been that central banks around the world have been buying back government debt, corporate debt from banks, pension institutions, companies themselves, with electronic money that the central bank has created. That's called quantitative easing. And that has had a weird effect on one of the key ingredients in the weighted average cost of capital, known as the risk-free rate of return. On some measures, that's gone down to 0 or even negative. Now, there are different measures over different time periods, but whichever one you use now are at historically low levels. And there is a theoretical concern here that actually the DCF model was designed in an era when you had sensible risk-free rates rather than the extremely low ones that we've been experiencing since the banking failures. Now, that means that you still have to use DCF, but it's another reason why one should be cautious about drawing too many conclusions from them. How do you test the veracity of these figures? Well, as Gary's pointed out, you can calculate from the results of a DCF an implied earnings multiple. That's that EBITDA multiple of 6.54 in this example, and you can use that as a sort of benchmark to say whether this meets a sort of reasonableness test. You can sensitize the outcomes for different assumptions, and as Gary's pointed out. So all of those together can help you sort of stress test the reliability of these numbers. But there are other reality checks as well that it's a wise thing to consider and do. And Garry, perhaps you could talk through some of those as well now.
Happy to. And before we change to the next slide, just as a sort of a ballpark range, where we're showing the multiple of 6.54 times, if you're looking at whether it's an SME business, whether it's one maybe a little bit larger, if you see a multiple after you've done a DCF and equates to a multiple of anywhere from 4.5 to 7, you should probably feel okay about the valuation number you've come up with. If you're looking at that and you would see something come out, unless you've got a proprietary product, patented technology, maybe an earlier stage business, if you saw an EBITDA multiple that was 10, 11, the red light should go on and you should look into that more, because that would be an extremely high multiple to see for this type of, the type of business that we're talking about in most cases here. So, that's just to give you some context on a general range. Anywhere 4.5 to 7, is probably, something you can look at and say, okay, the DCF is probably fairly close to what it should be. So in terms of then the reality check, how do you compare, and verify that the multiples you're looking at, really are reasonable? And that leads us to the next slide. So we have two additional valuation methods that are fairly commonly used particularly in transactions, and then William will talk a little bit about their applicability with schemes and tax valuation. But the comparable companies method and the comparable transactions method use similar approaches but require slightly different adjustments to come up with the equity value or the, what you would pay for the company. So under the comparable companies method, you're going to look at the universe of listed companies, and you're going to try to find some that are as similar to the business that's being valued as they can be. One of the big issues that you do have with this method and with the comparable transactions method is really finding a valid comparable set. Especially if you look at smaller businesses that are being valued, they may be very specialized in their focus, and there may not be a directly comparable set of companies listed. So what you have to do is try to find similar sized businesses in related industries, related sectors, and use those as the basis. What you would then do is take those listed companies and you would look at their characteristics, you would look at the multiples, whether it's price earnings, whether it's an EBITDA to enterprise value, whether it would be turnover to enterprise value or equity value. You would come up with a set of financial measures that you could apply comparatively to the business being valued. Now, when you do that, you're going to come up using comparable listed companies with a minority priced share value, because the shares that you see traded are going to be for less than a control position in the company. So if any of us were to go out and buy 100 of a listed company, we're not paying for control. We're paying for an investment and for a minority stake in that business. So there's going to be a discount applied in coming up with that share. That share is trading at a discount to what somebody would pay for control. So what you need to do then, if you're going to use the comparable companies method, is take that minority price and then add a control premium to that, to equate to what the number should look like if you're valuing a control position in the company from an employee ownership trust perspective, or even a company sale perspective, if you were looking at a third-party sale, which leads to another piece of uncertainty in terms of what that control premium should be. There are publications that will publish studies of these types of things, but again, trying to find a direct apples-to-apples comparison of the companies being listed and their valuation multiples with the valuation target is difficult at times. But it does give you, again, a reality check on what you derived in the discounted cash flow model, because if you're coming up with widely varying values for the value of the company, then you need to go back and take another look at some of the assumptions you're making, whether it's in the cash flow assumptions going through the terminal value period, which is where a lot of variation can occur, whether it's your discount rate, etc. Now, comparable transactions actually looks for data on transactions that have completed within a given industry sector. So as you are looking at, let's say a supplier to the automotive manufacturing industry, you would look at transactions that have occurred with firms in that sector. It can be difficult to find data because a lot of these are private transactions. Even if a listed company might buy a privately owned company, you're not going to always be able to get that data. So you would look at that and say, this company was purchased for 8 times last year's EBITDA number. So you would look at that and say, okay, that's a starting point. Now, how similar is that transaction from a size and a sector perspective? If it's a larger company being purchased and the number is applicable to that, you're going to need to discount that as well for size, and that's going to reduce the multiple that you would then apply to the business being valued for the EOT. And you'll make those kinds of adjustments, but you don't have to adjust for a control premium with the comparable transactions method, because that does involve the purchase of control of a company. So those multiples really just need to be adjusted then for the company size and potentially for a little bit of a lack of marketability or liquidity discount. So you will still adjust it, but it won't be trying to build up to that control value. So most valuation firms, when you're looking at a commercial transaction, are going to assign less direct value to these. They'll generally start with the DCF model, but they will virtually in all cases come back and do these valuations using the listed companies and comparable transactions to make sure that there's no inconsistency with what they've done across the board. They want to make sure that those valuations are within the realm of the reasonable from all three perspectives. So that's from a commercial perspective. Now, William, you want to talk a little bit about tax?
I think that's right. I think we need to just have a little step back now to think about the context in which tax valuations take place. I mean, the kind of commercial valuations that Gary's been describing are often the basis then for actual transactions. And if you have an actual transaction, well, then that is a pretty good guide to the tax value as well. But very often we have to create theoretical values for tax purposes, where there isn't actually a transaction price. And there, one, as mentioned earlier, one is governed by a set of rules and precedents that have grown up in the UK for valuing companies. And that sometimes does take you away a little bit from the classical business valuation approach that Gary's been describing. Often you have to be relatively pragmatic sometimes in order to get at a value that HMRC is going to accept in line with practice and legislation. Just so on that theme, I just think it's probably a good point now to answer that second question. What happens when a shareholder sells 100% of their interests to an EOT, and how that might differ from a valuation and outcome perspective if they sell only a majority but not the full holding. With sales to EOTs, the CGT relief, whereby there is no CGT payable on the sale, is only available where a controlling interest is sold to the EOT. Now, let's imagine for a moment we have a situation where scenario one, where the shareholder sells 100% and receives 6.5 million as the proceeds and market value of that holding. Because they've sold it in this structure to an EOT, the capital gains tax that would otherwise be payable at the rate of 10%, assuming the entrepreneur's relief is available, doesn't have to be paid, doesn't arise. Great, that's one of the great benefits of EOTs. So in fact, the proceeds that are available to the shareholder are the full amount without any tax. Whether they can actually receive that money, of course, is a quite different matter to do with the cash flow of the business. But that's the net. Now, if the shareholder decides actually not to sell 100%, it gets more complicated from a tax outcome and a valuation perspective. So let's think about scenario 2. In scenario 2, we're assuming the shareholder sells initially the controlling interest of 55%, holding back 45%, and let's assume they sell that remaining 45% in 3 years' time, and let's also assume, for simplicity, that the company's underlying value has not changed in that time. It's remained at 6.5 million. Now, what would happen here? Well, first of all, the vendor would only receive up front, or have it as a disposal rather, for 55%. So it would have an initial value received of 3.6 million. That's 55% of 6.5 million. Because it qualifies for the EOT controlling interest CGT relief, that means that 360,000 of CGT is thereby saved, compared with 650. Now, if in 3 years' time the remaining 45% is sold, one of the big differences is that at that point the CGT exemption does not apply on that second disposal. You would still, at that point, on the value and gain made at that time, have to pay capital gains tax. With a 45% holding, one assumes that it will qualify for entrepreneurs' reliefs. So the tax rate will only be 10%. But then you get into quite an interesting question as to what is the value that a shareholder in those circumstances will receive or can expect to receive for their 45% holding. Now, one approach would be to say, well, really, I'm just selling the remaining 45% of a controlling holding, and the value that the trustee should pay me is the pro rata value of the controlling holding. I.e., that would be the 45% of 6.5 million, about 2.9 million. Another school of thought might say, well, by this stage, things have changed. The majority of the shares are now controlled by the EOT, and that significantly restricts the potential buyers for a 45% holder. And because it significantly restricts that potential market, that may need to follow through with a very substantial discount for minority in this case. I mean, in share valuations generally for tax purposes in the UK, one can often agree with HMRC really quite high discounts, something in the region of maybe as high as 80%. And that's, I mean, as I said, Garry comes from the United States. It's not like that. In the United States, the equivalent of HMRC probably wouldn't tolerate, for tax purposes, discounts much above 30%. So we're very, very fortunate in some respects in this country in having that level of discount. But that is the product of the case law, the legislation, and the practice that has evolved in the UK over a period of time. So potentially one could be looking at, you know, discounts of maybe 80% or even more, arguably. That, of course, would lead if you follow that reasoning through, not just for tax purposes, but for the commercial value that the vendor is due at this time, you end up, of course, receiving a very substantially less 9 million. So, you know, the person who delays selling has consequences. First of all, that the value that they receive is subject to tax, and of course it's subject to tax without necessarily being able to realise any value at that time, which you potentially get one of these very unpleasant things called a dry tax charge, where you have a tax charge but you don't have any money to pay it with. But you can also pretend there is the question is how much will the actual underlying value be paid by the trust? Is it the full value of the company with a controlling interest, or is it very heavily discounted? I think this is an area where practice can vary from case to case. For this illustration, we've chosen a midpoint, 50%. We're not saying that's the right discount at all, but it's shown there as an illustration. And you can see in that situation, instead of receiving 2.9 million, the vendor would only receive 1.46. They'd have some tax to pay on that. So at the end of the process, because of the delay, in this situation, the individual receives net proceeds of 4.9 million versus 6.5. So the point here is that valuation and the approach you take to valuation, particularly on the subsequent sale of the minority interest, actually has quite a big effect on the ultimate return for the shareholder. Postulated was, how do you incentivize successor management? EOT structures can be really very attractive for exiting, retiring owners, but what about the next generation who are going to be running the business? How can you provide some incentive to them? if all the shares are held in the EOT, then they benefit from the collective benefit that that brings, but there's no direct shareholding for, say, 60 employees. Now, the legislation that was introduced a couple of years ago anticipated this issue, and a really important feature of EOTs is that although they are very often structured with ultimately a controlling corporate entity at the form of the trustee company, the corporate trustee, that would normally disqualify a company from being able to grant options under tax-favoured arrangements. But there's a specific exemption for EOT-owned companies that allows the tax-favoured arrangements to be put in place. So potentially, if it qualifies, meets the other conditions, EMI options can be granted to management over shares outside of the EOT arrangement. And if you don't qualify for EMI, then there are other arrangements, less tax efficient, but you can also use various forms of options as well. The structure of one of these deals often does create a sort of window of opportunity, if it's to be taken, to grant incentives where the value of the shares has been influenced downwards by the existence of the debt funding that was necessary for the vendors who sold the shares. So, you know, the enterprise value that Garry referred to earlier will be the actual value of the equity, the actual value of the shares that we're concerned with for tax purposes, can be further reduced by the existence of the debt that has to be paid off to the vendors. So that can create situations where, you know, potentially quite a lot of equity can be granted within the tax-approved, tax-advantaged limits. Again, there is an issue here about how you value these shares, which is a bit similar to the question of we addressed in the broader context of the vendor selling the balancing interest. What if the tax advantage schemes were over shares in a quoted company? Well, that's easy. But if, as normally would be the case with EOTs, it's over unlisted shares, you've got to, at the time of these award, value the shares. And then again, you've got to address this issue of what discount is appropriate. Now, in this case, we are dealing with minority holdings rather than very large, near controlling stakes. So you can see how a different valuation for tax purposes might arise for the award of equity incentives to a few individuals compared with the tax value that might be relevant when the vendor is selling a very large number of shares. Garry mentioned earlier that there are various approaches to valuation, and we think one of the most fruitful ways of looking at the valuation issues of EOT and companies is to try and stand in the shoes of a lender. I mean, the shareholders who are selling their shares very often will become effectively lenders as a result of the EOT transaction. And so I think at this point Gary's going, particularly with his former hat on as a banker, is going to actually talk about how bankers actually would look at valuation and how that can be potentially relevant in this EOT environment.
Okay. Thank you, William. Yeah, again, in my background, I've lent into these transactions for a number of years as well as structuring them. And the one thing that has become very clear over many years of doing this is that if you're asking a lender to finance a transaction like we're discussing, you know, they actually don't just look at the annual cash flow and say, oh, okay, I'm covered by the projected cash flows, I can get repaid. They're going to look at the transaction, you know, a little more, call it holistically, and say, you know, can this really be paid off over a reasonable time frame? You know, they do a lot of transactions, maybe not specifically at this point as the market grows EOTs, but whether it's, you know, trade sales, private equity sales. So they look at it, and they understand, and they know, and they require that a transaction be paid off over a reasonable time frame. If you went to them and said, here's a transaction we'd like you to finance, but based upon the value, it's going to take 15 years to pay off the debt, they're going to look at that and say, that really doesn't work. There's something wrong based upon the cash flows and based upon the value. That's not a reasonable valuation level. And our position, I think I say our being William and me, is that you have to look at value, whether it's you as a vendor who is going to finance the transaction, or whether you're planning on taking this to a third-party lender at a valuation level that they can look at and say, yes, this is commercial, it can be paid off, and the transaction, completely delevered, repaid over a reasonable time frame. Very important concept based upon, again, years of experience of doing these and seeing other lenders do the same thing. So the real question becomes, how do you define what a reasonable time frame looks like? And I think it's gone up in terms of longer over recent years. If you go back 15 or 20 years, most lenders would look at something and say, you need to put enough equity into a transaction that you can pay off the transaction debt in a 5 to 7 year period. That would be the more traditional model where you would put in 35 or 40% of the purchase price as equity, finance the rest, and then move forward. This structure is different in that in most cases it's going to be 100% debt financed, whether it's a combination of a bank or a third-party lender, or a combination of that with the vendor, or whether it's all vendor financing. But the reality is, it's still debt, and it's still 100% of the purchase price. So if you look at that, you realistically have to extend that time period over which you can pay the debt back. And on the commercial side, there's something called unitranche debt that basically just sort of combines the features of bank debt and longer-term junior capital. And most of those lenders are willing to look at 10, maybe a little bit longer than 10 years as a repayment period. So you sort of start with that premise and say that if a transaction can't be paid out, and we'll arbitrarily, within the window I'm talking about here, 10 to 12 years, we'll arbitrarily say 10 years is the level beyond which it becomes non-commercial. When you go beyond that, we would look at that as something that we would say is a strain valuation. You're really pushing the envelope in how much you're saying the business is worth. So those that would be reasonable and commercial, we're going to talk about as an unstrained valuation. It's reasonable, it's full price, but it can also be realistically financed on commercial terms where if you went to the market, you would be able to find somebody to finance this deal for you. So if you look at that, then the unstrained valuation really says we start out with a certain amount of leverage from a bank perspective, we pay that down, and then we refinance the vendor loan that's outstanding, and we can still get the debt completely repaid over a 10 to maybe 12-year period. That's important. That's commercial. Beyond that, you really start to raise some questions. I think our feeling is, as to whether or not this is an overvalued transaction, which is the number one issue that a trustee is going to look at. If they can't look at this and say, I am comfortable or I have a valuation opinion that this is a fair market value deal, there are some implications down the road if they've paid more than fair market value for the business. So having said that, what does it look like in practice? So the next slide that we've put together walks through what a transaction would actually look like, and don't get too caught up in the whole page full of numbers in front of you. There are a couple of things I want to point out to you as we go through here, and show you what the important aspects would be from a leverage perspective to get us repaid in a 10-year period. So again, same assumptions that we laid out earlier for the case study. You can see those in the upper left. We're assuming a reasonable amount of bank debt of 2.5 times EBITDA. That's what the multiple refers to. So in this case, our initial bank loan is going to be £2.5 million. So these numbers are all going to be in thousands of pounds. And then what we've done is gone through this and sort of laid out a repayment schedule. So to get to our full purchase price plus expenses, you can see we also have junior debt or a vendor loan of roughly 4 times. So our capital structure is £2.5 million of bank finance and £4 million, give or take, of vendor finance. So as you start out, you can see the 10-year period. These are the projections that we took from the prior example that we showed, and then we continued to run these out over a full 10-year period just to see what it would look like, assuming that same growth rate we discussed. So you'll start out, if you go to the line that says beginning senior debt, we've looked at a 5-year repayment on the debt itself. So the $2.5 million initial debt, in theory, gets repaid in full over 5 years. What's going to happen, though, as you go down, you can see the initial debt, less repayment. We've got the 5 years of $500,000. If you come down below the initial debt number, you'll see something that says plus incremental debt. So what we're doing here is we repay the bank finance, is we are then refinancing part of that junior debt. So in this example, in 2017, we've paid down £500,000 of bank debt. 2018, we've paid down £500,000, but then we've also incurred an additional £500,000 of bank debt. Now, if you go down a little lower, you'll see where it says beginning junior debt. What we've done here then in 2018 is we've paid off $500,000 of the $4 million. And the reason we would want to do that is more expensive debt, first of all. So just from a purely economic perspective, we're going to be trading 8% debt for 5.5% debt. So you're reducing the debt service obligation of the business, and you're also continuing then to pay down the overall transaction debt by doing this, because when you go from the $4 million, that doesn't get repaid on any kind of a schedule. The senior lender is not going to allow for a repayment schedule of that junior debt. They're going to require that it be repaid by them refinancing it over a period of time. So then that same approach follows if you look going back up to the senior debt schedule, where you've got the repayment of the $500,000, and then we're actually each year, where you see the plus incremental debt, we're actually then going to be, in effect, drawing down and repaying the vendor loan and transferring that to senior debt. What's going to be key to a lender is if you go down about 3/4 of the way to the leverage calculations, we never go above the 2.5 times bank debt multiple. That's a comfort level. Well, for certain companies, banks will be more than happy to look at something slightly more than that, but that's kind of a bright red line for a lot of lenders, that they want to stay below 2.5 times leverage. So as you can see, even with the incremental debt we're adding, with the paydowns that we've built into the schedule, we go through this 10-year period, and basically by the end of the 9th year, have completely repaid all of the junior loan, all of the vendor loan, and we're left then right at the end with basically just a small amount of debt at the end. So at 10 years, we have remaining debt of £693,000. So this falls well within the parameter of the unstrained valuation where you can pay off. Realistically, you're going to pay paid out much more quickly than that, because if you go down to the very bottom slide, the very bottom of the slide where it says cash surplus and deficit, based upon our debt repayment schedules, based upon the interest and the principal repayments, we're still going to be generating excess cash flow going out from basically 2020 through the end of that period. So what would happen in reality is the bank is going to more than likely say, okay, you have this excess cash flow here that basically is going to sit and build in your account. We're going to recapture that, and we're going to use that to incrementally pay down the debt. So when you look then at those numbers and then you look at the outstanding debt amounts, you're probably repaid somewhere 2024. You've completely paid out, assuming you're using the excess cash flow to further pay down debt. So looking at that, this is a commercial structure that should be financeable, and the valuation in this case, because as you look at it, this cash deficit up front, and what that basically means is there might be the need to accrue a little bit of the interest on the junior loan in the first couple of years. But the fact that even the first couple of years were a little bit tight on the cash flow, even going out to 2020 is a little tight, I think this valuation is still within the unstrained valuation range, but it's likely at the top end given the projected financial performance of the company, just given the fact you don't start out with any excess cash flow. So that sort of walks you through, what, in our view, an unstrained valuation would actually look like. The cash flows get the deal paid off over that 10, 12-year period. So,
I mean, Gary, that's very informative. But of course, it does. Underlying all of that is that buyers and sellers, as we've said, can have very different expectations, and numbers can bring out the existence of those different expectations, but they don't reconcile them. So, what ideas do we have really to perhaps bridge the gap, as we put it, between the expectations of buyers and sellers in the context of an EOT structure?
Yeah, that's a good question. It's a very big issue that has to be dealt with in a number of cases. You have a seller who thinks their company is worth £7 million. You have a buyer, in this case the EOT, with its valuation looking at its head down, that thinks the business is worth £5 million. So how do you find a medium point where everybody can come out of this in a sort of a win-win situation? There are really two ways you can approach it, and there are probably others as well, but the two primary ways are really techniques that have been brought to the EOT world from traditional merger and acquisition work. It's basically through what we'll call equity options or warrants that are granted by the business, or through an earnout, which is a very traditional way of reconciling differences. Just on the earnout first, what you would do with the earnout is basically set up a says, to the extent, and it can be any measure you agree, but to the extent, we'll say EBITDA exceeds a target for a 3-year period, for a 2-year period, 5-year period, doesn't really matter, but to the extent that it exceeds the projected performance, a certain percentage of that will then be paid to the seller. So if the company does in fact perform better than the numbers that were the basis for the valuation, the seller is going to be able to receive additional consideration that gets them closer to what they thought the business should be worth. Very common technique. It's been around forever in the merger and acquisition world, and can be used here as well. One of the other techniques, and this really sort of ties to the financing structure, is the use of equity options or warrants. So in our scenario, we have a reasonable level of bank debt, but the majority of the transaction is going to be financed by a junior vendor loan. Junior capital in the marketplace. So if you went out to complete a transaction as a buyer, you would be able to raise a certain amount of bank debt. You would be able to raise a certain amount of junior debt or mezzanine capital, subordinated debt, however you'd like to refer to it, on top of any equity you'd be putting into that transaction. In this case, there's no equity going in. It's all debt. The seller is in effect trading equity and equity returns for debt and debt returns. So it's a much riskier investment. So you need to provide them with an additional return for taking that long-term risk and really facilitating the transaction. So if you looked at this and said junior debt in the market would typically have a warrant or an option position attached to it, and what that means is it basically gives the financing source, and I'll say this and then explain it, the right to buy additional shares in the company at some point in the future. That provides them with returns that increase the overall risk-adjusted return they earn. Now, the reality is if we've done the 100% sale, we really don't want them to actually exercise those options and purchase the shares. So the way you would want to structure it is basically, we call it a cashless exercise. So in effect, they would exercise on paper, and then they would immediately turn around, and those shares on a phantom basis would be, quote, sold to the business, and the business would then be obligated to pay them for the value. So they don't actually take the share ownership with this structure, but they receive the benefit of having owned those shares. And going back to the point that William made earlier about the timing being critical, what you would want to do is implement these and let the vendor, in effect, receive their grant almost immediately post-completion, because at that point, the value is nil if you have 100% debt, and the upside for that vendor is basically any increase in the value of the shares from completion to the time they're able to sell back, which is typically going to be after the debt's repaid. So you're realistically looking at an 8 to 10-year time horizon before these get sold back to the company. So you've got the increase in company value from better performance, you have the increase in value from delevering the business, and then you have that incremental return that brings them up to probably an average of 12 to 14% all-in return for being that junior debt provider. And yeah, it really is a way of bridging that gap, because they want more in most cases, or they want full price. You know, they don't necessarily want to break the bank, but you can usually justify from a commercial perspective warrants for 15 to maybe 20% of the equity, depending upon how much of the capital structure they're providing. For a 100% vendor finance transaction, 5% would be a very reasonable number to look at. If you're talking about filling the gap after you've brought in 2.5 times of junior debt, maybe it's a 10 to 15% situation. But that really does allow you to bridge the difference. So those two techniques are what you would look at.
Well, thank you very much, Gary. I'm afraid we've actually overrun our allotted time, so regretfully we won't be able to answer at this point any of the questions that people have raised. But fear not, we won't forget them. We will seek to respond to you after this webinar. And indeed, some of the questions, I think, will be relevant to the next webinar, which will be held on the 7th of December, where we're very fortunate to have as our speaker Tony Spindler, who is the head of, or joint head of shares valuation at HMRC. A very special opportunity to ask him some of the pressing questions currently affecting share valuations for employee share schemes. Thank you very much for your time, and I hope you enjoyed the webinar.
Yeah, thank you very much. We appreciate it.